In this video, I'll be documenting my recent stock purchases as well as the monthly and all-time performance of my portfolio. My main focus with investing is to build passive income through dividends, and for anyone that doesn't already know, any dividend income or capital gains made in a stocks and shares ISA is completely tax-free. Compound investing is slow to start with, but over time the power of compounding snowballs, and if you start early enough, you'll see huge rewards down the line. My aim with this series is to be as transparent as possible with my investments and portfolio in general. I hope this will help others to see the realities of investing as well as the highs and lows along the way. As I've been documenting my portfolio in detail since day one, you can get a sense of how things progress over time in real world market conditions. Consider subscribing so you don't miss out on regular updates. The content of this video should not be taken as financial advice. I'm simply sharing my own experiences. In ascending order now, from the worst to best performers in my portfolio this month. First off, it's Bluefield Solar Income Fund in the energy sector. Bluefield Solar is an investment fund that's involved with renewable energy. With many government targets aimed at reducing carbon emissions in place, renewable energy seems like a good place to invest over the long term. In addition to this, Bluefield Solar has a solid dividend of 5.99%. As I purchased my shares in Bluefield when the price was a little lower, the dividend I personally receive currently sits at 6.62%. This is known as dividend yield on cost. Bluefield Solar is down 3.2% this month, but still up 9.25% over the past year. National Grid next in the utilities sector. Companies in the utilities sector tend to be more resilient during a recession. National Grid also has an impressive history of reliable dividend payments, as well as dividend increases. The dividend currently sits at a very respectable 5.15%. National Grid is down 2.32% this month and 7.12% over the last 12. On to the iShares Core FTSE 100 ETF now. This ETF mirrors the FTSE 100's performance, so it's a great way to add some diversification to your portfolio. This ETF also offers a decent 3.75% dividend. Index-based ETFs are a relatively simple way to get started with investing, as they remove the need to carefully pick stocks based on their financial statements and predicted future outlook. The iShares FTSE 100 ETF is down 1.97% this month and 0.64% on the 1-year time frame. Tesco now in the consumer staples sector. Consumer staples is another sector that tends to be less affected by recession, as it consists largely of things people need rather than want. Tesco also pays a very nice dividend of 5.15% with a dividend cover of 2.3. This means that Tesco can comfortably afford to pay for the dividend. Anything over 2 is considered to be good. The month of December saw Tesco's price drop by 1.92%, which further increases the yearly decline to 23.49%. Staying in the consumer staples sector now, it's Unilever. Unilever is one of the world's largest consumer goods companies and sells products to over 190 countries. Unilever has been around for over 100 years and consists of over 400 different brands. I believe Unilever to be a staple in most dividend investors' portfolios, and for good reason. With a dividend of 3.47%, it's currently the lowest in my portfolio, but with Unilever's rock-solid foundations and strong history of growth, I'm more than okay with that. Unilever is up 0.06% this month and 4.65% over the last 12. On to my first purchase in the healthcare sector now, and also the best performer this month, it's GSK. As with Unilever, GSK is another brand that has an extensive global reach. GSK currently pays a dividend of 4.61%, which is paid quarterly. GSK is up 1.57% this month. However, despite this increase, it's still down 10.71% over the past year. Here you can see each individual stock's performance from best to worst in a nice, easy to read and more visual format. As you can clearly see, the overall trend was down this month. Here's a look at the performance of the sectors. This is based on the stocks I own in the sector and not the sector as a whole. On to sector weighting now. Keeping track of your portfolio's weighting in terms of sectors like this will help you to ensure you're not overly exposed to any one sector, as this can leave you open to unnecessary risk. In addition to tracking the sector's weighting, It's also helpful to keep an eye on individual stocks. The goal is not to simply have all your positions be equal in size, it's more to ensure that no one or two stocks start to overly dominate the portfolio. You don't want to be in a position where you're overly exposed to one stock and some sort of unexpected negative event has a huge impact on the company's share price and therefore your portfolio's value too. I've decided to start keeping a small percentage of my portfolio in cash going forward, so it's there ready to snap up bargains when I see them. I'm thinking around the 5% mark when my portfolio is a bit bigger, but maybe a little higher for now, as 5% of my current portfolio is not really a meaningful amount. This month I added a total of 1,097 to the account. I aim to add around 1,000 per month for the time being. The account lost £12 in real terms once you subtract the money that was added this month. The portfolio's market value currently sits at 2,740, which is a 66% increase on the previous month. I really find seeing these bars increase month by month highly motivational. Due to the fact this account is still pretty much brand new and I just missed out on the ex-dividend date on most of the stocks I own, there's still nothing to report in terms of dividends. I've chosen to include this section anyway to set the structure for upcoming videos and so that I can look back on it in the future for motivation. As a dividend investor, this section is what it's all about for me and I can't wait to see it start to grow. Thankfully, my first dividend is due next month. So far, the total return on investment of my portfolio is 2.8%. As the account is only 2 months old, you can times that by 6 to get the projected annualized ROI, which would be 16.8%. However, it will likely be less than that in reality, as I started investing during a pretty significant dip, which has since evened out. Here you can see how my portfolio's ROI fares against a few popular indexes over the same time period. If you found any value in this video, then consider liking and subscribing as it really helps out with the algorithm at this early stage. If you do have any questions, please feel free to ask in the comments below. Check back soon for the next update, as things get more interesting when the dividends finally start to flow.